Imagine taking $1,000 and turning it into $165 billion. Buffett wasn't born into billions, and he certainly didn't start with insider secrets. Born in Omaha, Nebraska in 1930, young Warren had a taste for business almost as soon as he could read. At age 7, he discovers a library book called "A Thousand Ways to Make $1,000. Now, most kids at that age are, I don't know, throwing baseballs or playing tag. Not Warren. He reads this book and thinks, wait, money isn't magic. I could make it. And he does. He starts selling chewing gum, Coca-Cola, door to door, small profits, pennies really. Those tiny hustles taught him discipline, pricing, and persistence. Skills that would eventually turn $1,000 into, well, something ridiculous. Fast forward a few years, Buffett's in high school, and he's not just daydreaming about money. He and a friend buy a used pinball machine for $25, stick it in a barber shop, and start collecting quarters. Then they scale to 3 machines. Eventually, they sell the business for $1,200. By age 15, Buffett's savings from paper routes, pinball, and farmland partnerships hit roughly $1,000. That's over $35,000 in today's money. Not enough to retire, but enough to start thinking seriously about how to grow wealth. By age 11, Buffett makes his first stock purchase. Using the $114.75 he'd saved, he buys 3 shares of City Service preferred stock at $38 per share. Almost immediately, the stock crashed to $27. He freaks out, holding on until it recovers to $40, and then he sells. Tiny profit. But then, get this, the stock rockets past $200. Lesson 1, impatience can be expensive. By his early 20s, Buffett had saved around $10,000 from his side hustles and early investments, enough to start thinking bigger. But he needed a system. That system came in 1950 when he read Ben Graham's The Intelligent Investor. Graham's philosophy? Buy crappy companies nobody else wants for pennies. Sounds kind of boring, right? But to Buffett, it was genius. It gave him a blueprint, a disciplined, patient, logical approach to investing. So he does what any obsessed person would do. He enrolls at Columbia Business School to study under Graham directly, then works at Graham Newman Corporation to get hands-on experience. And by 1956, at 25, Buffett starts his own investment partnership. This is where the story gets really interesting. Because here Buffett isn't just playing with pennies anymore. He's hunting bargains. He's buying unloved companies. And he's learning what it really takes to turn small wins into a fortune. All right, now things get serious. Buffett's 25, fresh out of school, and he starts his own investment partnership with $105,000 from friends and family. He only puts in $100 of his own money. And invest he does, like a man on a mission. He follows Graham's cigar butt strategy, buying cheap, unloved companies. These aren't glamorous picks. They're neglected firms that nobody thinks have value. But Buffett sees a hidden payout. Take one of his first legendary plays, Sanborn Map Company. You might never have heard of it. They made maps for insurance companies. Sounds boring, right? But Buffett noticed something most of Wall Street ignored. Sanborn's stock was trading at $45, but the company had $65 in cash and investments per share. Wall Street was pricing the company as if it had zero value. Buffett buys as much as he can, eventually 43% of the company. Then he doesn't just sit there. He becomes active in the company, joining the board, and pushes management to unlock hidden value. They ended up repurchasing shares at $65. Boom! 44% gain for Buffett's partnership. This was Buffett's first real proof that his strategy worked. He spotted a company that everyone else overlooked, acted on it, and made a solid profit. It showed him that buying cheap hidden value businesses could actually pay off. But here's where it starts to get more interesting. In 1964, the American Express salad oil scandal hits. Investors panic after one of American Express's subsidiaries lost millions in a scandal, causing the stock price to plummet. Most people run. But Buffett, he leans in. Looking beyond the crisis, he sees that people are still using Amex cards. The brand, trust, and core business are intact, so he plows 40% of the partnership's capital into Amex. And guess what? It works. The stock rebounds, multiplying profits for Buffett's partnership. Now we're seeing something crucial. Buffett is evolving. He's not just buying cigar butts. He's learning that sometimes it pays to buy quality businesses at a temporary discount. By 1962, his partnerships have grown enough that Warren Buffett becomes a millionaire. And this is with money he largely managed for other people, not even his own. At 32, he's already turned a few $1,000s into a multi-million-dollar personal fortune. And yet, this is just the beginning. This is where Berkshire Hathaway enters the story. A failing textile company, but cheap enough to tempt him. He buys in. thinking it's just another investment. But then the CEO pulls a fast one and tries to lowball Buffett on a deal. Big mistake. Buffett doesn't take that well. Instead of walking away, he decides, fine, I'll just buy the whole company, which he does purely out of spite. He takes control, fires the CEO, and instantly realizes he's made a huge mistake. He now owns a failing textile mill. It's one of the few times his emotions beat his logic, and it cost him. But ironically, that bad move became the foundation of everything he'd later build. Around this time, Buffett reconnects with Charlie Munger, a guy just as sharp, but with a completely different way of thinking. Munger tells him straight, Warren, stop buying garbage companies just because they're cheap. His idea? Buy great businesses, even if they cost more, because they'll keep making money for decades. In other words, don't buy a company that's almost dead. Buy one that can print cash forever. And that idea completely rewires Buffett's brain. The next test comes when he's offered a candy company to seize candies. The owners want $30 million. Buffett thinks that's insane for a business with only $2 million in profits. But Munger pushes him to see the brand, not the balance sheet. It was a brand people loved so much they wouldn't flinch when prices go up. Buffett finally caves and buys it for $25 million. Best decision of his career. Over time, See's made Berkshire over $2 billion. That one deal proved Munger right and turned Buffett from a bargain hunter into a buyer of unbeatable businesses. So after the See's deal, Buffett finally gets it. The real money isn't in cheap stocks, it's in great businesses. Now Buffett starts hunting for more See's candies. Companies with loyal customers, strong brands, and steady cash flow. In 1973, during a market downturn, he spots one, the Washington Post. The stock is cheap because investors are scared, but the business is solid. It's one of the most trusted newspapers in America. Buffett invests $10 million. That stake later becomes worth over $1 billion. Then in 1976, another crisis hits. Geico, the insurance company, is on the verge of collapse. Everyone's running for the exits, but Buffett knows the business inside out. He's studied it for years and sees a cost advantage no one else appreciates. So while others panic, he doubles down, pours money in, and saves Geico from going under. That single move turns Geico into one of Berkshire Hathaway's crown jewels and proof that Buffett's new playbook works. By the late 70s, Buffett's no longer the guy digging for cigar butts in the bargain bin. He's building an empire of businesses, each one compounding quietly, year after year. By the late 80s, Buffett had mastered the art of waiting for the perfect business at the right price, and in 1988, he finds it, Coca-Cola. The stock had stumbled after the 1987 market crash, and investors were nervous. But Buffett saw something they didn't. This was a company selling a product people were addicted to, with a brand recognized in every corner of the planet. He starts buying and buying. Eventually, he pours more than $1 billion into Coca-Cola, the biggest investment of his life at that point. For most people, that would be a career-ending gamble. For Buffett, it's a masterstroke. Within a few years, his $1 billion stake triples in value. And here's the crazy part. He still owns every share. Today, that same position is worth over $25 billion. And Coca-Cola pays him about $700 million in dividends every single year. It's the ultimate example of what Buffett calls letting compounding do the work. By now, Buffett isn't just rich. He's become the model for long-term investing. And it's all built on one core belief. Find businesses so good, you never have to sell them. By the late 90s, Buffett actually looked old-fashioned. While everyone else was throwing money at dot-com stocks, Buffett refused to join in. No internet startups, no tech IPOs, just Coca-Cola, insurance, and railroads. The media started calling him out of touch. CNBC questioned if the Oracle of Omaha had lost his magic. Even his own shareholders began wondering if he was too conservative, but Buffett stayed quiet. He'd seen this movie before, people chasing hype, thinking this time is different. Then 2000 hits. The bubble bursts. The NASDAQ crashes nearly 80%. And suddenly, the old man who didn't get it looks like a genius again. His portfolio barely flinched while others lost fortunes overnight. When 2008 hit, Wall Street was burning. Banks were collapsing, stocks were crashing, and the same people who once mocked Buffett's boring strategy were now calling him for help. This was Buffett's moment. While everyone else panicked, he started cutting deals. Not as a bailout, but as a businessman. He lent Goldman Sachs $5 billion, demanding a 10% dividend and a fat redemption bonus. He did the same with General Electric. These were desperate companies, and Buffett was their only lifeline. When the dust settled, those crisis deals made him more than $10 billion in profit. And here's the irony. He didn't have to predict the crash. He just had cash ready when everyone else didn't. In 2007, Buffett made a bold public challenge. He said, "I'll bet $1 million that over 10 years, a simple S&P 500 index fund will beat any group of hedge funds you pick. Wall Street laughed and hedge fund managers jumped at the chance. Surely they thought their complex models could crush a boring index fund. Buffett didn't pick the stocks. He just picked the market. One single low-cost index fund that tracks the S&P 500. Then the 2008 crash hit. Buffett's index fund fell hard, down more than 37%. The hedge funds seemed to win early, but Buffett didn't panic. He'd seen crashes before. And year after year, the index fund recovered slowly and steadily. By 2017, when the bet ended, Buffett's index fund was up 126%. The hedge funds, barely 36%. Warren Buffett didn't just win the bet. He humiliated an entire industry that sold complexity as brilliance. Buffett donated the $1 million to charity, but the real prize was proving his lifelong point. Simplicity wins. Today, Warren Buffett's fortune hovers around $165 billion. He learned that money isn't made by chasing trends. It's made by understanding value, staying patient, and letting time do the compounding. So the next time someone sells you a get-rich-quick plan, remember this. Warren Buffett got rich slow, painfully slow, but he's proof that slow, when done right, can still win the game.